The price of silver didn't just rise after hours, it screamed. What you're about to see is not normal. This is not a chart climbing a gentle slope. This is a financial rupture, a dislocation that occurred when most of the world was asleep, on a Sunday evening in the electronic shadows where the real games often begin. The metal just catapulted to $106.55. Let me be absolutely clear. I am not selling you anything. I will never manage your money, never offer you a paid signal, never run a fund. My only pitch is for your attention and your critical thinking. Guard your capital fiercely. What follows is analysis, not a sales pitch. Now, why does this single number printed in thin overnight trade matter more than weeks of slow grinding action? Because it's a flare shot into the dark sky of the global market, and it's illuminating a crack in the very foundation of how we price this ancient metal. That move happened on the electronic, nearly 24-hour trading platform run by the CME Group. When the floor traders in New York and Chicago have gone home, this is where the machines, the international desks, and the large strategic players operate. Liquidity is thinner, the market's pulse is faint. So when a cannonball of buying demand lands in that quiet pool, the splash isn't absorbed, it creates a tsunami wave. That wave tells you one thing with terrifying clarity. Someone, somewhere, needed exposure to silver right then, and they were willing to pay a premium that shattered the calm to get it. This isn't a speculative day trader. This is size. This is urgency. And in a market where 99% of the trading is in paper contracts that never intend to see an ounce of real metal, a move like this is the sound of a straining leash. Let's connect the dots because they've been lying in plain sight for over a year. The inventory of silver registered and available for delivery against these paper contracts, it has been hovering at multi-year lows. It's like the gas gauge is on E, but everyone keeps signing contracts to drive across the country. At the same time, the premium you pay to actually get a physical silver coin or bar in your hand has stayed stubbornly, persistently high, often several dollars above the reported spot price. Dealers wait for supply, mince backlog orders, and then on a quiet Sunday night, the price detonates. So let me ask you a simple, logical question. If silver is merely an abundant industrial commodity readily available, why does it behave like a scarce strategic asset? Why does it gap up violently when the market is at its most vulnerable instead of drifting? The uncomfortable answer is that the story of abundance is a comfortable fiction. The above-ground stockpiles that buffered this market for decades have been systematically consumed. For years, industrial use has quietly outpaced new mine supply, and now that slow burn has met a gasoline truck of new demand. We are launching a new industrial age, and it is built on silver. Solar panel installations are breaking records. Every electric vehicle uses multiples more than a gas car. The rollout of 5G and AI infrastructure is insatiable. This isn't a future projection on a PowerPoint slide. This is purchase orders being signed right now. The deficit isn't coming, it is here. But here's where the technical picture makes this overnight explosion even more significant. Silver had been coiling in a tight range, building pressure like a spring. Chartists were watching for a clean break above a key resistance level. What they got wasn't a breakout. It was a blast door being blown off its hinges. That is the signature of a short squeeze, a panic buy, or a massive institutional order hitting a market with no shock absorbers. And when this happens outside of regular hours, it often means the real stress test is just beginning. Let me pull back the curtain on the mechanics. During the day, the market is thick with liquidity providers, bullion banks, and market makers whose job is to smooth the ride, to take the other side of trades, to keep everything orderly. But at night, that crowd thins out. The safety net has holes. When a large buy order falls into that net, it doesn't bounce. It crashes through until it finds a level where enough sellers emerge. The stark message from this Sunday night: at the previous price, there simply weren't enough willing sellers to meet the buy order. At near all-time highs, buyers are still chasing. Now, let's layer in the geopolitical reality, because no market moves in a vacuum. We're witnessing a great fragmentation. Nations are turning inward, prioritizing security over globalization. We've seen export controls on critical minerals, antimony, gallium, germanium. The whispers about potential restrictions on silver, a metal critical to both technology and national defense, are growing louder. Imagine if a major producer and consumer decides to lock its doors and keep its silver for its own industrial plants. The rest of the world is left outside, looking in at an empty pantry. Simultaneously, in the rest, a bipartisan drive to restore manufacturing is underway. The CHIPS Act, the Inflation Reduction Act, these are trillion-dollar commitments to build a future. And that future, as we just established, is silver-intensive. So we have a perfect, terrifying collision. Policy-driven demand surging from one side and geopolitical supply constraints rising from the other. In the middle, a pricing mechanism built for a calmer, more connected world. What we saw was the first tremble. Of course, I must give you the full picture, the bear case. Volatility is a two-way street. A violent spike on thin liquidity can reverse just as fast if it was a one-off order or triggers profit taking at the open. We've seen flash crashes and spikes that evaporated by lunchtime. Risk 1. This print doesn't hold and we slide back to retest support. Risk 2. The reaction of the established powers. Not necessarily central banks directly, but their commercial counterparts. The large bullion banks and market makers whose job is to smooth the ride, to take the other side of trades, to keep everything orderly. But if the concentrically short position is threatened, they have tools. They can sell futures aggressively to cap the rise, influence narratives, or even lobby for rules changes. We saw the playbook in 2011. Repeated margin hikes that forced leveraged longs to sell. So could the same happen now? Possibly, but only if you believe our current central bankers can orchestrate a graceful soft landing, tame inflation, and restore unwavering faith in debt-based currencies. Given the mountains of debt and the fracturing world order, that faith seems to be in shorter supply than silver itself. Let's crystallize 3 key takeaways from this event. 1. The overnight explosion is a symptom, not the disease. The disease is a structural physical shortage colliding with a paper market built for abundance. The world for which the system was designed is gone. 2. The volatility is real and painful. Drawdowns will happen, head fakes will shake out the weak hands, but the long-term trajectory is governed by a physics of supply and demand that no central bank can repeal. 3. The divergence between paper and physical is the single most important chart to watch. When these two realms reconcile, it won't be a polite meeting. It will be a violent collision. This isn't speculation. It's industrial desperation. So where does this leave us as observers, as thinkers? We are left in the tension of the unknown. We don't know if this price will hold at the New York Open. We don't know if this is the first salvo or a lone flare. We don't know how the powerful short positions will respond. But we do know the landscape has never looked like this. The fundamental drivers have never been so aligned and so powerful. The buffer between shortage and crisis has never been so thin. Your worst risk isn't volatility, it's being on the wrong side of a physical truth. Therefore, your task is not to gamble on the next tick. Your task is to verify. Check the inventory reports yourself. Watch the premiums on retail physical metal. Follow the quarterly production reports from the major solar and automotive companies. Track the geopolitical headlines about export controls. Build your conviction on evidence, not on the emotion of a green or red candle. If you're considering an allocation to this base, let your strategy match your belief. If you believe in the physical shortage thesis, then the physical metal itself is the purest, simplest expression of that trade. It's immune to counterparty risk, to bank bail-ins, to the whims of a futures exchange committee marriage rules. Its volatility is a feature, not a bug. It's the market's inefficient way of searching for a price that matches reality. For others, it might be about capitalizing on the volatility itself, or investing in the companies that bridge the supply gap. But in any case, let the strategy flow from the evidence, not the other way around. This channel exists to navigate these complex currents with you, to separate signal from noise in a world drowning in it. We connect the disparate dots of geopolitics, market mechanics, and raw human psychology to see the larger patterns forming. If this deep dive brought you value, if it helped you see the board more clearly, then the single greatest thing you can do to support this work is to like this video. It tells the algorithm that this kind of long-form, thoughtful analysis matters. It helps these ideas reach more independent thinkers like you. And of course, I want to hear your thoughts. I've pinned the question at the top of the comments. Which scenario do you think is more likely in the next 6 months? A sustained breakout above $120 or a return to sub $100 consolidation? Why? Let's get a debate going. Read others' perspectives, share your own. The collective insight in this community is powerful. We began with a scream in the night, a digital price print that broke the calm. Remember, markets are stories. For years, the story of silver has been a quiet, technical one, told in chart patterns and economic reports. But a new story is demanding to be told. It's the story of scarcity in an age of abundance, of industrial necessity in a fragile world, of a paper fantasy straining against a physical truth. That Sunday night spike wasn't the end of the story. It was the first loud, clear sentence of a new and likely turbulent chapter. Thank you for spending your time with me here. Do your own research. Trust your own logic. Invest in your understanding. I'll see you in the next one.